Did you know that experts predict that Tesla stock will explode after the split? According to some known Tesla bears, the EV company's stocks will be at around $200, the same amount during the split by the end of the year. However, some say that Tesla stock will soar just after the split. Stay tuned and keep watching to know more about this. Tesla bulls and bears' opinions are always at odds. While bulls have seemingly impossible high valuations for the company's stocks, bears predict extremely low prices for the same stock. With today's economy, it is quite challenging to predict whether Tesla is leaning towards a high valuation or a lower one. In today's video, you will find out why Tesla stock will explode after the split. On August 24th, shares of Tesla closed out the session trading around $891. When markets opened for trading at 9:30 a.m. the next morning, shares were priced at approximately $302. Shares of the electric vehicle maker Tesla rallied in after-hours trading on the 24th as the company's 3-for-1 stock split went into effect. The second such move in around 2 years as the world's most valuable automaker looks to make its stock more affordable. Tesla stock began trading on a split-adjusted basis after the market close on August 24th, with each investor gaining roughly 2 additional shares under the latest stock split, which was approved by shareholders earlier this month. Tesla first announced the proposed 3-for-1 stock split in June as a way to make the nearly $900 stock more affordable. Based on today's closing price, the new share price would be just under $300 per share. Tesla shares are up roughly 25% since announcing the 3-for-1 split in early June, while news of Tesla's 5-for-1 stock split roughly 2 years ago sent shares over 70% higher in the 20 days following the announcement. For the most part, shareholders love the idea of stock splits. It's nice to have at least the perception of getting something for nothing. But a stock split doesn't necessarily mean that anybody's getting anything of additional value with their money. A stock split does not affect the fundamentals of a company, but makes it easier for individual investors to do small trades. Many experts assume the Tesla split will make the company's stock more affordable to retail investors. However, even after the approval of the 3-to-1 proposal, Tesla's stock is still down more than 28% year-to-date. This is roughly in line with the broader market, and the NASDAQ Composite Index, which Tesla is on, is down 20% year-to-date. With its stock price approaching $1,000 per share, Tesla has had a hefty price tag for most retail investors for quite some time. The 3-for-1 stock split should change all that, and it could spur more retail investment in the company. According to Ally's chief money and market strategist Lindsay Bell, when stocks trade in a so-called comfortable range, everyday investors can more easily afford a piece of the company. That drives more interest in the shares, and more interest means more people trading the stock. On August 25th, however, Tesla shares closed 2% lower as a 3-for-1 stock split announced by the world's most valuable automaker to woo retail investors came into effect. The stock opened at $302 and closed at $296.07 as the split allowed investors to get 2 additional shares for each they owned as of August 17th. It had closed at $891.29 before the split. B. Riley chief market strategist Art Hogan said that stock splits certainly have a higher appeal to retail investors and make their options more affordable as well. What does the stock split mean for Tesla? Typically, a stock split signals optimism in a company. It also indicates confidence that the share price will eventually rise to a level near or surpassing where it stood before the split. Tesla shares' recent performance shares support such an interpretation. Over the past month, Tesla's stock has surged, rising more than 6% as of early trading on Tuesday. Prior to a drop over the past week, the stock had risen more than 13% since a month ago. The EV company reported mixed second-quarter earnings, which showed a decline in profit of nearly 1/3 from the previous 3-month period, in part due to production slowdowns at a factory in Shanghai amid COVID lockdowns. When compared with the same quarter a year ago, Tesla's profit had doubled and revenue had grown 42%, signaling strong growth over the long term. Still, on the whole, the company's shares have suffered a difficult 2022, falling more than 18% since the outset of the year. That drop is in line with each of the 3 major stock indexes, which have plummeted this year. Still, despite those odds, plenty of doubters, and regular criticism over its actions, Tesla has developed into the leading manufacturer of electric vehicles globally. The automaker has grown rapidly, and so has its share price. What are your thoughts about Tesla stock today? Let us know in the comments section below. The following are the reasons why the share price is likely to continue moving higher once the split is done. First, more factories mean more vehicle deliveries. It's a well-known fact that Tesla has faced challenges meeting the demand for its vehicles in the past because of production constraints. In fact, despite the company's incredible growth, a lack of manufacturing capacity has slowed it down. However, that is about to change with the opening of 2 brand new gigafactories in Austin, Texas and Berlin, Germany. The 2 new additions aim to take Tesla's manufacturing capacity to 2 million vehicles per year from 1.05 million previously. Unfortunately, the company still has to contend with supply chain issues for raw materials and components like semiconductors, which is a problem all car makers are currently facing. Second, more deliveries mean a higher gross margin. A gross profit margin is simply a company's revenue minus its cost of goods. In Tesla's case, its automotive gross margin would factor in the price of the car less the direct cost of making the car. It would include costs such as the raw materials required to build each vehicle, but it wouldn't count marketing or money spent on research and development. Those are operating expenses. As Tesla builds more cars, its gross margin increases because of a phenomenon known as scale. If Tesla builds a factory that can manufacture 500,000 cars but only produces 50,000, it would lose money because it's absorbing the cost of that extra capacity without actually using it. When it produces all 500,000 cars, its fixed costs are at the smallest possible percentage of its revenue, which leads to a higher gross margin. Since Tesla has been delivering a record number of vehicles, its gross margin has consistently climbed higher, and it's now sitting at the best level in the company's history. Third, a higher gross margin means higher net income. Net income is a metric most investors watch closely. Put simply, it's the company's bottom line or profit. It's also important because when it's divided by the number of shares in circulation, it becomes earnings per share. Many pundits predicted Tesla would never reach profitability because making cars is difficult and expensive. Even some of the best car makers like Ford can only muster a gross profit margin of around 15%. But Tesla has developed industry-leading processes for producing electric vehicles, and the quality of the finished product allows for premium pricing. Tesla's gross margin of 32.9% leaves far more room for operating investments like the design of new products and the development of innovative new software technologies like autonomous driving, which can help keep the company ahead of its competitors. But more importantly, the high margin results in more money flowing to the bottom line, and in the first quarter of 2022 alone, Tesla generated over $3.3 billion in net income. In conclusion, Tesla's stock split will not create more value for investors, although it might broaden the shareholder base by inviting new smaller investors into the fold, thanks to the more affordable price per share. The company's rapid expansion of manufacturing capacity and consistent profitability are the items that will continue driving its stock higher both before and after the split. In fact, the stock split is not predicted to have an impact on Tesla stock in the long term. Craig Earlham, the senior market analyst for Owanda in New York, said in an interview, Tesla's stock split is a sensible move given the current share price, but it may not make a considerable difference to its performance over the long term. Retail traders and Tesla employees may be happy with the move, but larger investors with the bulk of interest won't be moved either way, Earlham added. While the dominance of institutional investors will limit individual participation, the split was designed to benefit employees while putting an eye on the retail segment. Tesla's total revenue grew 81% year-over-year in the first quarter to $18.8 billion, while operating income improved to $3.6 billion. However, the second quarter numbers were down following the company's Shanghai factory shutdown. Despite the second quarter slowdown, Tesla still hit an operating margin of 14.6% and produced a positive free cash flow of $621 million, while ending the quarter with the highest vehicle production month in history. The company is slated to release its third quarter earnings, production, and deliveries in October. Visit Tesla stock and watch our other videos for more of this content.